Hi guys and welcome. Now we've already discussed trend line trading and what it can do for you, and obviously your trend is your friend and you always follow the trend. And as I said, this week we're going to look at simple moving averages, because simple moving averages have been around for a long time and they help you in a large way. Ignore these stochastics at the bottom here and the MACD. The MACD, which is the moving average convergence divergence, is one of my favorite indicators, and we will go into that at a later stage, and I'll indicate to you why I use that at length to decide on my trades. But for now, let's have a look at simple moving averages. Now, in the old days, what a lot of people would do is they would take a simple moving average, like a 20-day moving average, and they would add it onto their system. Basically, a 20-day moving average would come out something like this. You can see the line appear there. Now, what people would do in the old days is when the price would go through the 20-day moving average, they would purchase the share at that price, and they would ride it up, and then when it comes back down through that 20-day moving average, they would sell it, and this would be profitable to them. But now, as you can see on this stage, you would have made no or very little profit. If you take costs into account, you would have made no profit. But if you'd kept it or not gone through the trade and you'd held it, it would have gone all the way up to here. When it came back through the simple moving average, you would have made a profit. Similarly, if you'd gone short here and waited for it to come back up, you still would have made a profit, just not quite as much as you think. And then here you would have purchased it again, it would have gone up, come back through the simple moving average, you would have made a profit. So basically that's what people used to do in the older days. Now, these days we don't worry about 20-day moving average too much. One can trade this way, but that's just a form of trading that people have used in the past. A better way of using the simple moving averages is if you take a 40-day simple moving average. Let's add a 40-day here quickly for you. There's a 40. And you take an 80-day simple moving average. So you put 80-day in here for you, simple moving average. Let's add an 80-day moving average, and let's make sure that it's a different color, because otherwise you won't be able to see which one's which. We'll make it bright yellow. That's bright yellow, simple day moving average. Now you can see you've got your 40-day moving average here. It crosses through the 80-day moving average, and it's a change in direction. Your 40-day is moving up. It crosses through the 80-day moving average, and it's a change in direction. And then all the way back, came back through again, but now you've got to be very careful. This is very close together and hasn't moved much, and it's got in a straight line. Now we can see that there's a change in direction to the upside here, not to the downside. So this is going to move up all the way, and the reason we confirm this is we're confirming this with the moving average, the MACD, the moving average convergence divergence. What on earth just happened there? There we go, it's back. Wow, that's strange. So, although this is showing a change in direction, you can't confirm everything with moving averages 100%. As you can see, like with a 20-day moving average, you might get it right from time to time, but not every time. Moving averages give you a directional idea of where the average of the price is going. This is not where you make your choice of trade. If you make your choice of trade on a moving average, it's going to be very difficult to make profit every time. You've got your trend, you know what your trend is, you know how to work with trend lines now, and you're working within support and resistance lines. One can use the simple moving averages to determine where the price is going, but always remember it's not going to be an exact science. It just gives you an idea of what's happened. Now, as you can see here with the 40-day moving average, you could also have used it the same way as the 20-day moving average. It goes through the average, you buy it, goes up, comes back down, you sell it. It moves up through the average, you buy it, moves back down, you sell it, moves back up, you buy it, and when it comes back down, you sell it again. So if you'd used it that way, you would have bought it at around 268 Rand, and you'd be waiting for it to go to its next level and come back through that moving average. So that's how you can use moving averages or simple moving averages. And another important moving average to use is the 200-day moving average. The 200-day simple moving average is a very important indicator, as this indicator, I wonder what color we can make this now so we can see it. Let's make it light blue. You can see it nicely here. Yeah, there we go. With the 200-day moving average, you don't want it to go through that at any point, because if it breaks the 200-day moving average, for example, to the downside, that means it's becoming bearish, and it could be problematic for you if you're in a long invested trade. So for investors, the 200-day moving average is very important. It's also important how close the price is to the 200-day moving average, because as the price moves away from the 200-day moving average, it becomes sort of, how can I put it, a worry, because it's going to come back to the 200-day moving average at some time. It always does. And another moving average that I use is either the 89-day or 100-day moving average. It also gives you a guideline as to where you're going. As you can see, you could also have traded this on the 80-day moving averages. It would have shown you very nicely, you could buy it, it's going up. When it comes back down through the 80-day moving average, you could sell it again. Now, these indicators at the bottom, the stochastics and the MACD, which are some of my favorites, the basic way to use them is when they're at the top, they'll match with the price. Okay, particularly the stochastic. The stochastic is fast, alright, and you'll see there's a change in direction, and when they meet at the bottom again, usually there's a change in direction that goes back up, and when they meet at the top again, usually there's a change in direction that goes back down, and when they're at the bottom again, it matches with the price, then it goes back up. Basically shows you an overbought and an oversold situation. But where I use the moving average convergence divergence, now that's really important, because as you can see, when this crosses over here, you start getting a change in direction, and when it goes through the zero line, then it becomes quite positive, and it goes all the way up to another point where you can see when it crosses back again, you can actually sell out of it. Comes all the way back down, and so on and so on. We'll go into detail with this in the next video. Thanks for watching, and back next time.